Cat, are you there?
I am.
Oh wow! So this must just be to get your mind off of things, huh? Maybe.
Yeah, and I need to make sure I pass this so I can retire him.
How are things?
Huh?
What's the latest? I was talking to somebody about today, and
Say it again.
I said I was talking to somebody today about Guapcoin, and I was talking
Okay.
about the community
Uh-huh.
of Guapcoin and really community, and and the reaction that I got from people to that message, like you said, the love felt good, like that. That's real, like built that community.
No, I appreciate that. I really needed that because before that, I was feeling very isolated, and it's good to know that people there are people there who care what happens to us. So it was good.
Yeah, people do care, and there's people who definitely do care. Go ahead and pull up the.
So
Hi, Julie. I'm not sure yet.
Hello.
Hi, Julie. How are you doing? Is that Julie?
It is. How are you?
I'm well.
Good.
Cat is on as well. She's the one I sent the text about, whose husband is being prayed for. So,
I have been praying for the entire family, and God is able.
thank you so much. Thank you so much.
Absolutely. Stay strong and know that God is with you. He will not leave you or forsake you. A scripture that is close to my heart is Isaiah 41:10. I'm sorry?
no, go ahead.
Yeah, scripture that.
Go ahead. The children just came running loud.
Oh, okay. The scripture that is very near and dear to me is Isaiah 41:10. And it just says, so do not fear, for I am with you. Do not be dismayed, for I am your God. I will strengthen you. I will help you. I will uphold you with my righteous right hand. And I'm just believing that.
Thank you so much.
For you and your husband, that he is carrying you both through this right now, especially interceding for your husband. And that God strengthens and keeps him.
Thank you.
Okay.
I truly appreciate it. so I don't stay with my own thoughts. I appreciate you. Thank you so much.
You're welcome. You're welcome.
You know, she mentioned that she was feeling isolated, and it's so easy to think that we're all alone in the world and that nobody else is with us and nobody else cares and nobody else has ever gone through what we're going through.
Yeah.
And when we wake up and look around and say, oh wow, that person's gone through something, and we stand up together in love and unity, that makes all the difference,
It
all the
does.
difference.
It does. Just know that you have people that are praying for you and that care for you and your family. Even though we may not know you, we may never seen you face to face, but love has no barriers. Care and concern doesn't either. And across the miles, there's no distance that can keep our hearts and minds from caring for what you and your family and your husband are going through.
So much. Thank you so much. This is so great for me because it's so hard for me to ask for help and to receive it. It's wonderful. Thank you. Thank you.
Well,
Absolutely.
we're gonna distract you just a little bit with, and I'm gonna ask you some questions that you're gonna just roll off your tongue that because you know it so well.
Okay.
But I'm gonna give you a little bit of a distraction tonight, just a little bit. And
I do, because I want to pass this because I'm going to retire him. You hear me?
what do you? I don't want to know what you. Well, what do you mean?
And I'm going to get the license.
She wants to retire. She
I
wants
want
to
to
retire.
retire.
Oh, yes.
I want to retire my husband.
Yep. Absolutely. All right. Now, for some reason, this thing doesn't want to work. Why doesn't it want to work? Chapter 4. Okay, I think I got it. Okay, here we go. Hey, Dawood, how are you doing? Good evening, Deborah. I don't think she's connecting yet. Let's see. Somebody was there. Oh, Anuket, Rodney, who just joined, is also a family member of the tribe. Oh, he just dropped out, I think. But okay, let me bring this up. So this is what they say they want us to accomplish today. I don't really feel like accomplishing much, but sometimes distractions are good, I suppose. So upon completion of this chapter, we will be able to define each standard provision, list the common exclusions, differentiate the different types of beneficiaries, provide examples of the beneficiary designation options, identify the life insurance settlement options, explain the non-forfeiture options, and list the dividend options. So Rodney, are you? Oh, there you are, Rodney. How about? Oh, he's not connected yet. Hey, Rodney, Rahabat. I just wanted to just introduce you quickly to everybody here. Deborah's here. Dawood, who's Donovan, is here. Sunshine's here. Especially want to introduce you to Anuket. She's a member of the tribe, and I don't know if you guys saw the text, but her husband is, pulling through with COVID from the depths. So, if you wanted to send her a quick positive energy, send her some green light. And then we're just going to distract her a little bit with some life insurance studies. And you are on mute if you want to come off mute. I'm not sure if that's on purpose.
Oh, Robert, sending positive energy to your husband. Let's bring him home. Get him some vitamin C. Get him some um, elderberry. Get him some colloidal silver. Get him all that stuff. Let's get him home. I'm gonna
Towel
mute
hat,
that.
towel hat.
All right, let's do that fool. I'm at the park with my grandchildren, so I'm gonna mute out.
All right. Appreciate you, Rodney. What do?
What I do? I'll be right here.
So these are some things that they will ask about. The provision describes the parts of the entire contract is this parts describes the parts of the life insurance contract. The entire contract consists of the policy, the riders or the endorsements, the amendments, and a copy of the application. All statements made in the application are, in the absence of fraud, deemed to be representations and not warranties. All parts of the contract must be attached and in writing. Nothing can be incorporated by reference. Any change in the contract will not be effective until approved by a company officer. The producer may not change the policy or waive any of its provisions. The incontestability clause: within the first 2 years of a policy, the insurer may contest the claim and void the contract upon proof of material misstatement or fraud. A material misstatement is one in which the insurer would not have issued the policy had they known the true information. Except for non-payment of premiums, the policy will be incontestable after it has been enforced for typically 2 years from the policy issue date, even in the case of fraud. What that means, if you can get past 2 years, no matter what you lied about, you're scot-free. I'm sorry, did I say that out loud? Insuring clause or proof of death. Specifically, the insuring clause is found on the first page of the policy, and is considered the most important clause in the policy. It identifies the parties to the contract and or conditions which will pay. Insuring clause is the insurance company's promise to pay the policy's death benefit to the named beneficiary after receiving due proof of death of the insured, as long as the insured died while the policy was in force. Consideration clause. The consideration clause, I never turned, hold on. How do I see whether or not I'm being, hold on just a second. Okay, I just wanted to make sure it was recording. The consideration clause specifies the amount and frequency of premium paid by the owner is something of value provided in exchange for the company's promise to pay. Suicide clause, in short, is typically within first 2 years, it's excluded, but after 2 years, they will pay. So now we have our first set of questions. The insuring agreement is life insurance policy states insurance company will not pay death claims in the event of a suicide or other exclusion named in the policy unless all premiums are paid in advance. That doesn't sound right. Insurance company may refuse to pay a death claim in the event a mistake is found in the original application or issuance at the time of the insured's death. That doesn't sound right. A mistake doesn't sound right. Insurance company is obligated to pay the policy proceeds upon presentation of valid proof of death of the insured, which occurred while the policy is in force. That sounds possible. Policy owner will indemnify the insurance company policy proceeds of the beneficiary. That doesn't sound right. But what is somebody else's guess? Oh, I didn't share it again. I thought I did. Oh no, yeah, I am sharing it. Any guesses out there?
Just a minute.
Yeah, I agree with you, see.
The insuring agreement is the basic promise to pay the benefit described in the policy when a claim is provided. In life insurance, a true certified copy of the death certificate is valid. The incontestability clause states that after 2 years, the insurer will not argue about which beneficiary is primary or contingent. That doesn't sound right. The insurer will not refuse to pay a death claim based on misinformation in the original application for insurance.
Yeah.
Information. Now, that sounds true to me, but I always read them all because they could have tricked us up with some words. Policy owner cannot sue the insurer for misstatements made by the producer in the sale of the policy. That doesn't sound right. An insurer will only pay for suicide if the insurer was insane at the time. That doesn't sound right. So you think it was B? Right. Incontestability means the insurance company cannot use the statements in the original application for insurance as a reason to avoid paying a death claim. The policy becomes incontestable after 2 years in most states. Owner's rights, ownership provision. The policy owner retains all rights in the policy. Assignment is the transfer of ownership. The absolute assignment, the original owner, the assigner will name a new owner, the assignee of the policy. Since a new owner is named, this is considered a permanent assignment. The full amount of the policy assigned, and this is referred to as a transfer of ownership. Collateral assignment. Collateral assignment does not cause a permanent change in ownership. However, the rights of the owner will be subject to the assignment. Collateral assignment is typically used when the insurance policy is used as collateral. So you could sign it over as collateral. Yes, to make sure that the loan is. Also, I want you guys to feel free to raise your hand or just to talk at any point if you have questions about anything you're seeing or hearing or have a question about. I really want this to be interactive. A misstatement of age or gender. If the age and or gender of the insured is misstated in a policy, all benefits under the policy will be provided based on the insured's correct age and or gender according to the premium scale in effect at the time the policy was issued. An insurer can refund any overpaid premium if the amount of premium paid was greater than should have been paid. The insurance can reduce the face amount in cases where the amount of premium paid is less than that which should have been paid. So that's actually good to know. They won't ask them to pay more money. They just might reduce the death benefit. For example, if the premium amount paid for the policy was 50% less than what should have been paid, then the death benefit will be reduced by 50%. Free look, right to examine period is a period of time, typically 10 days, where someone has the right to look at the policy and then change their mind. Exclusions are conditions stipulated in the contract for which the insurer will not provide coverage. The insurer cannot add or alter any of the exclusions after the policy has been issued. Such exclusions are normally limited to the following: aviation, status clause, no coverage for individuals with military status since these individuals are provided coverage through the government. The results clause or the war clause, no coverage if death is a result of war, declared or undeclared. If death occurs during the period of war, only the premiums are refunded. Most insurance companies, however, will do the right thing. For example, 9/11, I believe all of the insurance companies paid the claims, even though that could have been declared as an act of war. Most insurance companies, on the life insurance side at least, try really hard to do the right thing. Most do, not all. Hazardous conditions, no coverage if death is related to hazardous occupations as stated in the policy, such as stunt drivers or auto racers. Hazardous hobbies or avocation, no coverage if death is related to a hazardous hobby as stated in the policy, such as skydiving or hot air ballooning. Suicide within the first 2 years. So standard provisions, individual policies only. The policy is applied for on September 2nd, accepted as an insurable risk on September 20th, mailed to the producer on September 22nd, and delivered by the producer in person to the policy owner on September 25th. The free look period begins September blank. So a policy was applied for on the 2nd, accepted as insurable risk on the 20th, mailed to the producer on the 22nd, and delivered by the producer in person to the policy owner on the 25th. So now we know that it's going to be in September, and we remember that it's how many days? The free look? 10.
And
So 25 plus 10 is not in September, so we can eliminate that. 10 plus 2, it was applied for then, so that's probably not it. Oh, shucks. Wait. So there's no 20, there's no 30. Okay, so what's the answer?
no, when does it start? It starts on the 25th when it was delivered. It's A.
When does it begin? See, thank you. I was looking for when it ended, even though it clearly says right there. So it was mailed to the producer. I
It
think
was-
it's the 20th. Oh, wait a second. No,
No,
well, it's
the
when they get it.
25th.
The
Right, 'cause
25th. You're right. When they get it. You're right. I don't know. But you might be right. Let's see. You're right. The free look period begins on the date the policy takes possession of the policy owner takes possession of the policy. Okay, that makes logical sense, and you're 100% right. See, you're basing it on studying. I'm basing it on, at best, memory, maybe, or logic. So I appreciate you, Anuket. Accelerated death benefits. Accelerated death benefits provide for the early payment of a person based on prior to death. This provides a tax-free access to policy benefits based on an insured's qualifying as terminally ill or chronically ill. The person is considered terminally ill when a physician has certified that the person has a condition which is expected to result in death within 24 months. The person is considered chronically ill if a licensed healthcare professional has determined within the last 12 months that the person is unable to perform at least 2 activities of daily living for at least 90 days without substantial assistance. Accelerated death benefits do not have to be repaid if the insured's health improves, but the amount received reduces the remaining death benefit. You guys hear that?
No, I did not hear that.
Okay, let me see. Please let me know if you can hear it now.
The mode or frequency of premium payment is how often premiums are
I
paid.
can hear it.
The more frequently the premiums are paid, the higher the total premium outlay. Premiums may be paid monthly, quarterly, semi-annually, or annually. Monthly premiums are the most expensive mode of premium payment, whereas an annual payment is the least expensive mode of premium payment. The grace period is the period of time after the premium due date before the policy lapses. If death occurs during the grace period, the beneficiary will get the death benefit less the premium due. The typical grace period is 31 days from the premium due date. A loan may be taken during the grace period to make the premium payment and keep the policy in force. If the premium is not paid during the grace period, the policy will lapse. The automatic premium loan, or APL provision, allows the insurer to automatically deduct the premium from the cash value to make a premium payment and prevent the policy from lapsing. The APL must be selected by the owner and does not require an extra charge to apply. If the APL continues to make the premium payment, the policy will eventually lapse once the cash value runs out. Reinstatement provision states, once the grace period is over, if the premium is not paid, the policy will lapse. The owner can reinstate the policy or put a policy back in force after it lapses due to non-payment. The insurer allows reinstatement typically within 3 years of lapse. The insured must show insurability and repay all premiums and loans to reinstate. Reinstatement is not allowed if the owner surrenders the policy.
The grace period in a life insurance policy is typically 31 days and provides for the insurance company to delay payment of the death benefit until they can determine the validity of the proof of death. That doesn't sound right. Payment of the premium to be received after its due date without a penalty or lapse in coverage. That sounds closer. Payment of the premium to be received after its due date with a maximum 5% penalty. I don't remember mention of a penalty. Policy owner to reinstate the policy before it lapses. The grace period in which the payment of the premium to be received after its due date for the policy owner to reinstate the policy before it lapses. What do you guys think? I think it's B or D. I think it's ultimately B. Let's see. Yes, the grace period allows payment of the past due premium without a penalty or lapse in coverage. Any claim arising but any unpaid premium will be deducted from the claim when paid. What is the primary advantage to the policy owner in the restatement of a life insurance policy? So this is after the policy has already lapsed. They also then give them a period of time in which you can then reinstate the policy by paying past due premiums. So A, the policy owner continues to enjoy the benefits that were provided in the original policy, including the original premium. That sounds right. B, the insured is not required to prove insurability if under age 40. That doesn't sound like it matters. C, the insurance company cannot start a new period of contestability. That sounds like it could be an advantage too. All policy loans that were outstanding at the time of lapse are forgiven and a full cash value is restored. That doesn't sound right. Anna Keck, come help me. The primary advantage to policy reinstatement is the policy owner continues to enjoy the benefits that were provided in the original policy, including the original premium. I think it has to be A.
I think it's A.
And without this whole new contestability thing, I think it's just a red herring to throw us off. Yeah, reinstatement restores the policy to its original condition as if it were never lapsed. Even though the policy is reinstated at a later age, the original issue premium is all that the insurer will require. So match the policy provisions with the correct description. 2-year time limit, policy issue, death, suicide is covered. I guess that's suicide clause. Grace period allows you to bring policy up to date if it has lapsed due to non-payment. So if it has already lapsed, which one of these do you think it is? Consideration clause, grace period, reinstatement, mode of premium payment, or insuring clause? If it is
Maybe?
lapsed, what will allow you to bring it back is reinstatement. So I think it's reinstatement. Right. Okay. So then the time period after the premium due date before the policy lapses, that is, I think, so what is that? So the period of time after the premiums are due, this is just true of every bill. What would that period of time be called? The time period after the premium due before the policy lapses. Consideration clause, grace period, mode of premium payment, or insuring clause.
I guess that would be the grace period.
Right. Sounds right. This provision identifies the parties, perils, and promises of the contract. Let's go to so this one, mode of premium payment is the frequency of payments. That makes sense. The provisions identifies the parties, perils, and promises of the contract. Okay, I think that's the insuring clause. And I think payment that is made in exchange for the contract, something of value, is the consideration clause, because consideration always has to do with considering something of value for something else of value. So that I'm pretty sure. So just remember, when you start to hear consideration, it has something to do with exchanging of value. And that means that this one, the insuring clause, is the provision that identifies the parties, perils, and promises of the contract. Any questions about any of that? I want you guys to sort of use this as an opportunity to hear these words, understand the strategy of study. The strategy is mostly to go through the questions and then try to get the right answers. But if you get the wrong answer, read the question and then read the right answer again. So match the policy provisions with the correct description. Party who has all rights to cash, loan values, dividends, and other benefits. That sounds like the owner to me. All right. We did read about this one. Does anybody remember what is the policy writer's copy of the application must be in writing and attached? Anyone remember what that was? I think it's the statement of age, entire contract, free look, incontestability, or assignment. So when you
Uh,
start talking, go ahead.
I would think entire contract.
That's what I would say too. Anytime you start talking about the parts of the contract, the policy, the riders, the application, it must be in writing, it must be attached. They're going to be talking about the entire contract. The rider is a part of the contract. The application is part of the contract. You put everything together, it's the entire contract. So if you were to transfer ownership rights, what do you think that is? Misstatement of age, free look, incontestability, or assignment? They start to get pretty obvious at some points. Transfer of ownership rights, anybody?
Assignment.
The insurer cannot contest statements, errors, misstatements, fraud in application after 2 years. Misstatement of age, free look, or incontestability.
Incontestability.
There we go, Daoud. Thank you. Benefits will be adjusted according to what premiums paid would have purchased at correct age or sex. Between these two, misstatement of age or free look, it's pretty clear that that's not age. Some of them are obvious. Most of them are obvious, but some of them will use really tricky words. The insured may return policy for a free refund, typically within 10 days of receipt of policy. So refund, 10 days, free look. Get those ingrained in your head. And you'll be good with that question, no matter how they ask. So just through this process, we've learned a lot. Ownership provision, entire contract, assignment, incontestability, misstatement of age, and free look. My guess, just through doing this exercise, when I said those words, you had a pretty good idea of what I was talking about. And that means that this is starting to work. If you have no idea what I'm talking about, that's okay too. Just let me know. But you can see that just familiarizing yourself with these concepts and these words, and especially over and over, it starts to really help. So policy loan provisions include all of the following except unpaid interest is added to the value of the loan. Interest is charged annually. Death benefit of a policy is automatically reduced when a loan is requested. So we're looking for policy loan provisions include all of the following except outstanding loans will be deducted from the face amount at the time of claim. So we know D is true. We know C is true. Unpaid interest is added value of. I don't even know what that means. Unpaid interest is added to the value. It's either A or B. Can somebody help me out? And the other thing we can do, actually, let's just guess this one because I want to see what it takes to get it wrong. So I'm going to pick one that I know is wrong. So the death benefit of a policy is automatically reduced. Oh, see, it was a trick question. The death benefit of a policy is automatically reduced when a loan is requested. That is not true. The loan comes out of the cash value of the policy, not the death benefit. But if the person passes away and they have a loan, that's when D comes out. Outstanding loans reduced from the face amount at time of claim. So this was a trick question a little bit, or at least I didn't catch it properly. So now we just need to know to watch out for this, that when you have a loan, it doesn't affect the death benefit. That's the blessing from this. Policy loans with fixed rates can have a maximum fixed interest rate of 8% or less as stated in the policy. Now, here's something interesting about policy loans. The interest gets paid to you, the person. It gets paid to you, the person, person who took out the loan, that interest doesn't get paid to the insurance. The advantage also to getting a lot of these wrong the first time you go through is that you will see many more questions. So the disadvantage of us guessing together as a group and getting most of them right is that we won't see the questions that aren't asked. So the owner of a cash value policy may surrender the entire policy. This action will cancel the insurance coverage. The policy owner is entitled to receive the cash surrender value in the policy. Universal life and variable universal life policies may have a surrender charge schedule which might last 10 to 20 years. The schedule would show what percentage of the cash value is subject to a surrender charge. The surrender charge schedule shows the percentage charge reducing on an annual basis. So an example is the end of policy 1 through 10. The surrender charge could go 10, 9, 8, 7, etc. The difference between the cash value and the cash surrender value is the surrender charge. This provides a means for the insurer to recapture the upfront expenses involved in issuing the policy. In other words, cost to pay us.
Policy loans and withdrawal options. Cash loans are outstanding loans and will be deducted from the face amount plus interest if the insured dies before the loan is repaid. Interest is charged, but if unpaid, is added to the outstanding value of the loan. Failure to repay the loan or interest will not void the policy until it equals the cash value. Policy loan rate provisions. If you take a loan from the cash value, the insurer will charge interest. If fixed rates apply, fixed rates on a policy loan cannot exceed 8%. Adjustable rates on a policy loan are based on Moody's corporate bond yield average. The loan amount cannot exceed the cash value amount. Interest not paid when due is added to the total debt. Partial withdrawals or surrenders are permitted when the policy is a universal or variable universal life policy. A surrender charge may be applied, which is an early withdrawal fee. Surrenders may be full or partial. A partial surrender is different from a loan. It is considered to be a partial cancellation and is not charged interest. The amount received is taxable once the amount withdrawn exceeds the amount of premium paid into the contract.
So that's a really important point I want to make. If you surrender a policy partially or fully, there could be serious tax consequences. So let's just say, for example, you put in $50,000 and now you have $100,000 of cash value. And you want to now cancel that policy for some reason. That gain of $50,000 above the premium that you paid is fully taxable if you cancel the policy. If you pass and the person dies with the policy, the death benefit gets fully passed on 100% non-taxable. So this is an important thing to understand. And I ran into somebody who had a really, really old, really, really bad policy that he took a whole lot of loans out on. And now he's having to pay those premiums just to make sure that the policy doesn't lapse, because he's made so much money on the policy that if he stops paying the premiums and the policy lapses, he's going to have a huge tax bill on his hands. So he's got to continue paying the premiums basically until the day he dies. The loan can be paid off from the life insurance versus from canceling it and then having to pay taxes. Honestly, it was a really bad situation that he was in. Mostly it was because he was in a really old, really bad product. That stuff is much less likely to happen now. There's a lot of provisions in there to keep it from happening. To just tell you very briefly, he got a policy back when they were promising 20% interest, like back in probably the 70s or the 80s when interest rates were just through the roof. And everybody was just making so much money everywhere in the stock market and elsewhere. So the interest rates were really high. And so they were promising the world. and then he was borrowing money based on these huge promises. And then instead of getting a 20% rate of return, maybe he was getting a 7% rate of return. So the policy didn't keep up the way they thought it would. So I know that was probably more than I need than you caught at the moment. Just understand that there's some things with surrendering policies that might be an issue, especially if you have a profit. The types of beneficiaries are revocable, meaning it can be changed, or irrevocable. Policy owner may not be changed. The beneficiary, so the beneficiary succession goes the primary beneficiary, the contingent or secondary beneficiary, and then the tertiary beneficiary. This is interesting. I want to clarify the difference between contingent or secondary. Oh, I see what they're saying. Okay, a primary beneficiary could also be more than one person. So I see what they're saying. So a primary beneficiary, and then they're using the word secondary or contingent is the same thing. So a primary beneficiary could be one or more people, and then a contingent or secondary beneficiary is if all of the primary beneficiaries pass, predecease the insured, then the contingent beneficiary, also known as the secondary beneficiary, will get paid out. And then tertiary. So that's what they were saying. Where did, oh, there it is. A contingent beneficiary has the right to receive the policy proceeds if the primary beneficiary is a minor child. Nope. Receive the policy proceeds if the primary beneficiary predeceases the insured. That sounds right. Share in the death benefit with the primary beneficiary. Nope. Prevent the policy owner from taking a loan against the cash value. Nope. So this is one of those, we just went through it. The contingent beneficiary receives the policy proceeds if the primary beneficiary predeceases the insured. A contingent beneficiary has no interest in the policy proceeds if there is a surviving primary beneficiary. Contingent and primary beneficiaries do not share the death benefit. Only an irrevocable primary beneficiary has the right to interfere with certain of the owner's rights in a life insurance policy. Policy owner who wishes to maintain all rights in the policy should designate a revocable beneficiary, irrevocable beneficiary, contingent beneficiary, or primary beneficiary. So a policy owner who wishes to maintain all rights in the policy should designate a revocable beneficiary. Otherwise, the beneficiary would have, if they want to be able to even have the right to change the beneficiary, then they have to have a revocable. Then none of these others, I don't think, are relevant. Let's check. Okay, in order to maintain all rights in the policy, a policy owner should name a revocable beneficiary. A revocable beneficiary would have to provide consent for certain changes to a policy. Primary, contingent, and tertiary beneficiaries could be named as either revocable or irrevocable. Oh, Anuket, that person is sending that stuff and it should arrive to your house for noon.
Oh, noon tomorrow? Okay, great. Thank you.
So you take it. She's sending me some information on it so we can review it beforehand. But if there's also any
Right.
way that you can get it to Sundiata, even if you have to, you know, anyway, we won't speak that on tape. We'll
I
talk.
know. Yes. Yes.
Anyway,
Uh-huh. Thank you.
the common disaster clause provides that if an insured and primary beneficiary die as a result of the same event, the primary beneficiary must survive the insured by a specific period of time, usually 90 days, or the insurance company will ensure the insured died last. Primary beneficiary died first. This provision is designed to pay the benefits to either the contingent beneficiary or the insured policy owner's estate if no contingent beneficiary has been designated. An example, Mr. and Mrs. Smith each had an insurance policy naming each other as the primary beneficiary to their respective policies and their children from previous marriages as the contingent beneficiaries. If Mr. and Mrs. Smith were both killed in a car accident at the same time, each insurer would assume that both died last to protect the next named beneficiaries in the policies. Interest only, life income with period certain, lump sum, and life income only are all forms of which of these insurance policy options? Dividend options, settlement options, beneficiary options, or non-forfeiture options. So now let's see. Interest only, life income with period certain, lump sum, and life income only are all forms of which of these insurance policy options? It seems to be settlement options to me. What do you guys think? Anyone have another opinion? Settlement options. These are all examples of death benefit settlement options, how the beneficiary will see the policy proceeds.
Settlement options include the interest-only option. The beneficiary will receive fixed monthly interest payments while the death benefit will be held for a future payout. The monthly payment is taxed as ordinary income. If this option is selected, the owner or beneficiary must designate how and when the actual death benefits will be payable. For example, the owner may choose interest only for their spouse or primary beneficiary and lump sum payout for the children or secondary beneficiaries. The fixed amount option pays a specified dollar amount per month until the benefit is fully paid out. Interest earned is taxable and extends the payout period. The fixed period option pays a benefit for a guaranteed period of time. The interest earned is taxable when paid out and increases the monthly benefit. A life income only option provides guaranteed income for the lifetime of the recipient. The death benefit is used to purchase a life annuity.
I don't know if you meant to share what you're sharing.
Payout options that can also be selected as settlement options. The life income with
What did you say?
I said you were sharing your Facebook.
Oh, yeah, I see.
period certain provides guaranteed income
it's
for the
better.
life of the recipient or a specified period of time, whichever is longer. This option is designed to be a life payment but provides a guaranteed minimum number of years. The life income with joint and survivor option guarantees income for the lifetime of both recipients. One check is made out to both recipients. After the first dies, payments continue until the survivor dies. The joint life option guarantees one payment to two recipients. The payments cease when the first recipient dies.
Internet's a little slow tonight, so.
Non-forfeiture options are options found in policies with cash value. If a policy owner no longer wishes to continue paying premiums, they can select an option so they do not forfeit the values already in the policy. The first non-forfeiture option is reduced paid-up insurance. The owner can choose to stop paying premiums and keep the whole life policy in force. The cash value will continue to build within the policy, but since the premiums are no longer being paid, the benefits will be reduced. Protection continues to age 100. Extended term is an option in which the current cash value will be used to keep the existing coverage in force as term insurance. The face amount remains the same, but will only provide protection for a limited number of years. The owner may also decide to surrender the policy altogether and receive a lump sum payment of the cash surrender value. This will cancel the policy outright. If any of these options are selected, the owner cannot reinstate a policy. Policy dividends are paid from participating policies, which are issued by a mutual insurance company. Dividends are paid out of divisible surplus at the end of a year. If the company has a surplus, they will refund a portion of that to their policy owners. Dividends are considered a return of excess premium and are therefore not taxable and cannot be guaranteed. Although the dividend itself is not taxable, any interest generated from the dividend by leaving it with the insurance company for future payout will be taxable as ordinary income. As a policy owner of a participating policy, the insurer will offer several dividend options. A cash dividend can be paid out and is income tax free. A dividend can also be used to reduce the next premium payment. In this case, the company will keep the dividend payment and apply it toward the next premium. The policy owner can also choose to leave the dividend with the company to accumulate with interest. The interest payments are taxable, but the dividend payout will not be taxed. Another dividend option is 1-year term. This option provides for additional term insurance protection based on the dividend amount. This is provided without insurability and expires at the end of the year. Paid up additions will provide for additional cash value insurance to be purchased with the dividend. This is additional cash value insurance that is added to the existing policy but does not require additional premiums in the future as it is paid up. The paid up option will provide for future premiums to be paid by the dividend and will eventually pay off the participating policy.
I think we're almost at the questions. Would you guys like to push through and finish the questions or just pick up the questions tomorrow since we're almost at 8 o'clock? Sorry about that. I got disconnected somehow. You guys hear me now?
I hear you.
Okay. Dividend options do not include which of the following choices: paid up additional insurance, lifetime income, refund in cash, reduced premiums due. Lifetime income doesn't sound right. That would be too good to be true. Lifetime income is a death benefit settlement option, not a dividend option. So I'm not sure if you guys heard me. We're almost at 8 o'clock. Would you guys like to push through and try to get to the questions or finish up chapter 4 tomorrow? We are actually halfway through the month of August, and I think there's more than 13 chapters. So my time period, well, this is the first time we're doing the classes. We'll see how long it takes us to get through it all. Does anyone have a vote? Would you like to end now, or would you like to try to push through and get through the questions?
I think maybe you should end now because people might plan to get off at 8.
Okay, I think this is the last screen before the question. So let's just do this one and then we'll go through and we can do these quickly. So we want to know whether it's a settlement option, a non-forfeiture option, or a dividend option. So we won't actually do the quiz. We'll just get to the quiz. Life income period certain sounds like a settlement option. Interest only sounds like a settlement option. Cash sounds like a dividend option. Life income only sounds like a settlement option. Paid up additions sounds like a dividend option. Cash surrender sounds like a non-forfeiture option or a forfeiture option. Joint life sounds like a settlement option. 1-year term, I think they mentioned as a dividend option. Reduced paid up is a dividend option. I thought. Reduced paid up, not a dividend option. Oh, I'm sorry, reduced paid up, that's right, as a non-forfeiture option. Reduced paid up means like if you've got $100,000 on somebody and then you stop paying the policy, I believe they give you some smaller amount of death benefit that lasts until age 100. But you can't reinstate the policy for the full amount. So extended term, I believe that is extended term might be a non-forfeiture option. Yep. Paid up option. Fixed period is a settlement option. Accumulate with interest, it sounds like a dividend option. Life income joint and survivor is a settlement option. Premium reduction is a dividend option. I think. And then a fixed amount sounds like a settlement option. There we go. So if I'm right, the next should be the quiz. And it is. So we will get to the quiz tomorrow and then start on chapter 5. Any questions so far? I want you guys to know that we're going to be doing these reviews sort of continually. So as soon as we finish with one, we'll go to another. We might change the states just to sort of mix it up a little bit. Right now we're going through Georgia. But if you miss anything at any point, I encourage everybody to go and download this software themselves. 80banker.com/FEG. That'll get you the discounted one. You want to get the $40 one. I think it's the cheapest option, whatever it is. It's the $40 one. And you don't have to buy any of the extras, but you can if you want. But just get through and go through the questions, try to answer the questions as best you can. And we will continue to do this and continue to have conversations. And if you are studying or if you have any questions here that you don't quite understand, ask Daoud. I'm available. Text me, call me. I'll try to put it into English as best I can and give you real world examples. But I appreciate you all. Deborah, if you could text me your phone number. It looks like you might be driving. So don't do that while you're driving.
I am driving.
Okay. Do you mind just telling it to me over the phone? Telling it to me here?
I'm at a red light.
Oh, okay. All right. Perfect.
I'm at a red light.
Okay. All right. Well, thank you for being here. And hello. It looks like there's some. I can't really see who else is in the car, but hello to everyone who's in the car. I thought I saw a child back there.
Yeah, in the car with me.
Okay. Got it. Thank you, everybody. Have a great night. And I wish you all peace. And Anuket, Sundiat is going to be all right. I just like to end with a quick, quick prayer or moment of silence to all of us, send healing energy to Anuket's husband. He's currently in the hospital with COVID, but he is going to pull through. I put out a message and somebody sent a response and saying they do have something that can help with the COVID. So, you know, through all types of miracles, we're going to get it and we're going to get it to him and it's going to somehow miraculously work. And, you know, there's going to be one more story of what the community does for people and how much we love and care about each other. So I love you guys. Everyone have a good night. And so right now we're going to do the classes Monday, Tuesday, and Thursday. And then Wednesday, it's the same time, that station is going to be Circle Fit Financial class, where we'll be going over product training and then just general discussion of strategy and how to do this job really, and how to get started making money immediately or as quickly as possible. So any questions before we end?
Thank you.
Thank you. I appreciate you
Yes,
all.
yes, thank you, everybody.
All right,
Thank you all.
Annika, we'll talk to you later. Love you.
Love you. Thank you.
Hey, Tower, check your saw. This is much appreciated.
Yeah, I appreciate you too, man.
All right, brother. I got some more people I need you to talk to also.
Oh,
right.
absolutely. We'll talk. That's right. I owe you a phone call from this morning too. I'm gonna call you in about 5 minutes.
That's fine. All right, good brother.
All right. Peace.
All right, family. Wadu.
Wadu.